One of the reasons is there are thousands and thousands of founders and just a handful of investors. And so those investors get spammed and they get harassed by founders. And that's why they usually resort to intros. Because through intros, like you said, through an accelerator, through someone they trust, they know that the qualification work is done and what they receive is good enough. That's how we help them level up as founders. Because the truth is, it's a journey. It's a journey. Nobody knows how to raise out of school unless you've had one of those very specific track records that you mentioned. But most people, they just don't know the rules. And we try to teach them the rules.
Welcome to the show, Stéphane. How are you doing?
Hi, Mark. I'm doing great. Thank you.
Yes, glad to have you here. You are the guy. You help tech founders raise funds worldwide for their startups through something completely new and revolutionary called the OpenVC app.
Well, Mark, as the first, thank you for your kind introduction. One of the challenges when you're raising funds for a startup, we're talking about tech startups, raising angel, pre-seed, seed round, is getting access to investors. Okay. I have my pitch deck, I want to speak with investors, and I just don't know where to start. Usually a couple of people, right? Family and friends or people in your network, but you only go that far. And so this is an online platform where you'll find investors who are interested in speaking with you. We have investors sign up to the platform. They tell us, hey, I want to invest in fintech or in biotech or whatever it is. And this is how founders can contact me. And we just facilitate, we enable that initial connection between both sides. So that's OpenVC in a nutshell.
This is quite disruptive, right? Because nothing like this has existed before. It has always been you go into some incubator, you create a pitch deck, you go to the channels of VCs, handful number of them, the accelerator ends and you're done. So it has been like this for years and years. What motivated you to just redo all of this and put it on its head?
Yeah, so I guess, and I'm not the only one, a lot of people would tell you there must be a better way. When you look at how this happens, this discovery phase happens today, it's very inefficient for both sides. So the intuition is that, oh, there must be a better way to do it. But then when you spend some time in that industry, you understand actually it's not that simple. There are reasons why things work that way. It's a feature, not a bug, the expression. And one of the reasons is there are thousands and thousands of founders and just a handful of investors. And so those investors get spammed and they get harassed by founders. And that's why they usually resort to intros. Because through intros, like you said, through an accelerator, through someone they trust, they know that the qualification work is done and what they receive is good enough. And that's the one different thing with OpenVC. We screen those deals. So you join OpenVC and you want to reach out to investors. We will make sure that every submission you send is relevant and is good enough. And because of that reason, investors trust what we send them and founders get results. And that's basically the one good thing about the concept is we're recognizing that there is value in intros and there is value in filtering and screening. But now we have created a fair access and a fair process for any founder to leverage that through OpenVC. So that's the concept that we try to turn intros into an accessible commodity, into a software product.
So who is in charge of actually making sure that the pitch deck is good enough to be able to be put in front of VCs?
So at this point, it's a fully automated process. So we have a checklist. So if you and it's public information. So if you follow the checklist, it's just going to, your deck will reach the investor. So I'll give you an example. I'll give you an example of what doesn't work. You're a biotech founder reaching out to a fintech investor. We're going to block you. Not relevant. It's out of scope. You're raising your pre-revenue. You're reaching out to a growth stage investor. You're going to get blocked. Not relevant. So these are simple facts that you can check. And that's what we do. And then on the other hand, there's everything related to quality. And that's harder to assess. But we look at a lot of signals. The team, just the quality of your materials. Ugly pitch decks, like stuff that is impossible to read, 50, 60 slide, font 8. We're going to block that. So honestly, it's common sense. 90% of that is common sense. 10%, we still make mistakes. I'll admit it, we're not perfect. But we're in the process of continuously refining this screening tool. But at this point, mostly it's that, right? Couple of hard points, couple of judgments.
I love it. It's a great concept because it really makes it accessible to everybody. Getting into an accelerator program, getting into an incubator is scary, and sometimes it costs a lot of money. This is democratizing the entire process, but that also means that a lot of people coming into the app may not have the formal education that they need, that they would receive from an incubator, the step-by-step process. So if I'm somebody, I graduated with my MBA, I have a tech degree before, I have an idea, but I'm very green and I just signed up for the OpenVC app. What are some resources that are available for me to even get to a point where I'm confident about my idea and then pitch deck and all of that?
Oh yeah, you're absolutely right. And this is an issue we faced early on with OpenVC. Okay, we actually started with the access side of the project, so building channels. And then we realized we actually send those people to, as we say in French, to the butcher, to get butchered. Because they're gonna get destroyed if they don't know, they don't understand the first thing about venture capital. We're setting them for failure. And so very quickly we started adding a lot of content to educate founders, teach them about fundraising. So now on OpenVC, as a founder, you'll find playbooks on valuation. Okay, how do I determine my valuation? How do I determine my round size? We have stuff about the pitch deck. How do you build a pitch deck? Step by step. And this is all very straightforward, step-by-step tutorials with illustrations, with real-life examples. And we decline that. So basically every aspect of the fundraising journey, we have content to help you along the way. And so many founders, when we block their submissions, we also tell them, hey, look at this or look at that content. And that's how we help them level up as founders. Because the truth is, it's a journey. It's a journey. Nobody knows how to raise out of school unless you've had one of those very specific track records that you mentioned. But most people, they just don't know the rules. And we try to teach them the rules before they raise so they are more likely to succeed.
I love it. I love it because that's where a lot of people get stuck. The initial stages of fear of what to do and just not having guidance. So this is a product that is just literally revolutionary, right? Because there's so many people who want to start their own company. There's so many people who have ideas, great or not, they have ideas, right? So as I can imagine the growth of this company with millions of people signing up worldwide because it's accessible. That also means that you have to have enough number of VCs on the other end to be able to support that many people. So what is the process of screening and bringing on VCs so that they can potentially support millions of people who are getting on this platform?
Absolutely. For one thing, we are just, a slice of the real VC industry, right? And so we're going to face the same challenges. And like we said, there's supply, there's demand, and it's very apple. So we're going to have many more founders than investors. How do we solve that? Part of that is solved with the product, the way the product works. So what's really cool is we see the whole pipelines, so we can control them. We can say, okay, this investor has received too many deals this week, so we're gonna disable his account for a few days so he doesn't get overwhelmed. This other investor has not received anything. Let's put him higher in the search results. So we have a lot of little tricks in the product. It's really UX, but because we have the data in the background, we see the data now, we have 6,000, I think, investors on the platform and thousands of founders every month using the platform. So we can do macro adjustments that are not possible in the real world because it all goes through our software. So that's how we solve for that. But the other aspect is how we keep bringing investors on board. So we started with VCs, then we opened up to angels, accelerators, family offices. So now we really have 4 types of investors, I would say. Anybody who invests cash for equity in tech startups is welcome to OpenVC. And we keep adding, I think, 50 to 20 every 2 weeks. And it's just at this point, we don't have much effort to make, honestly. It's just they see other investors on the platform and they just want to join and be there as well. It's a kind of gregarious behavior. So we just leverage that. So today it's okay. Today we don't have really, this is not a challenge for us. We would love having more investors on the platform and we welcome them with open arms, but it's not, it's not a limiting factor at the moment. We just found we struck a good balance between supply and demand and they grow harmoniously side by side. So it's okay.
Love it. I love it. So do we have any data on the type of deals that are being made? What particular niches? What is the conversion rate? Just for audiences to understand like how it's working behind the scenes.
Talking about both supply and demand, it's fairly similar. 40% in the US, 40% in Europe, and 20% rest of world. So that's our geographic breakdown. Stage, angel to seed Series A. So anybody raising from 100K to 10 million USD, would be at their place at OpenVC. Industries, that's very broad. So we're going to have software stuff, we're going to have hardware, we're going to have biotech, we're going to have quantum computing, or sometimes even like next generation nuclear technology. But obviously it's going to be a lot more SaaS than exotic stuff. But we will really have all sorts of things. We're pretty agnostic. So that's what it looks like in terms of investors and founders. It's a fairly good cross-section of what the space looks like in reality. And then if we're talking about performance metrics, how people fare on average, for the first half of the year, first half of 2020, founders had 60% open rate, meaning they send the decks to VCs and VCs open the deck 60% of the time, and 40% reply rate. So 4 founders or 4 submissions out of 10 receive a reply, meaning a yes or a no. And a yes means yes, let's get on a call, and no means sorry, not interested. So these are the numbers we track, and we track them. We compare ourselves with a typical cold emailing where people would get way lower than that. So we're happy with those numbers, but obviously we want more. And the goal is to get 100% reply rate. That's really, if we can get that next year, 100%, that'd be fantastic. But for now,
60% out of the bat is high. That's a really high number, and 100% would be out of the world.
That'd be amazing. 40% is already very solid. I would also, to be fair, it really depends on the company. Some companies have insane reply rates, 80% plus, and other much lower. It's just what venture capital is. It's a very, again, so.
Let's talk about how you created this company, because you had an idea, you realized there was a lack in the process, how things are done. You're sitting somewhere, you have an idea. Tell us the step-by-step process that you took to get where you are. Because there's somebody here who's thinking, man, I have a great idea myself. It disrupted entire field of work. How do I go about it?
Okay. So if we go back to the very beginning, the idea stage, I think it was team. And at the time I was working at Microsoft. I was working for their startup accelerator in Paris. And I was in this very nice co-working space that we owned in downtown Paris. And we were working with a batch of startups that we helped raise funds. And everyone was sitting in that co-working space side by side, working on their own investor lists. And I thought, that's weird. Like, why don't we have a common resource that we can all tap into? Because there is a lot of overlap. Everybody's like doing the same job, researching the same people in separate files. So that's weird. Started playing around with some tools at the time to solve it, but I'm not technical and I couldn't do much. Fast forward, then I have my whole life. I moved to San Francisco, come back to France, started for startup, blah, blah, blah. 2021, maybe, I discovered Airtable and no code. Felt, okay, I can actually build that. So I built the first version of OpenVC, found a co-founder who is technical, Luca, and today OpenVC is both of us. And he built the front end and all the stack that we needed. So to this day, OpenVC still runs on Airtable, by the way, fun fact, right? We run an app that has 1,200 new users, even more than that now, per month, thousands of submissions. Everything is run in Airtable for like $49 a month, which is really cool. And yeah, so that's when we started building. We built as a side project for 2 years because we couldn't figure out the business model. We were not sure this was even a business opportunity for real or just a side project. So 2 years just working nights and weekends. Then we went full time 2 years ago. And now we're profitable and growing and everything is going well. But it took 4 years to get there.
Was there a time when it wasn't going well, when you started doubting things?
Plenty. Like I said, a lot of people would jump headfirst into their startup project. But for us, we're like, this is a bad business to be in. And honestly, it is. Like, we work with founders and VCs. So for those who don't know, founders are broke and VCs are cheap. And VCs think they already have all the deal flow they need. So why would they care for OpenVC? So there are many good reasons not to do it, honestly. But we just had this intuition that there must be a better way, that it's just so inefficient and we just needed time to experiment with a lot of stuff and twist the model in all possible directions. And eventually we found out, okay, there is an angle which is not obvious and a bit counterintuitive because we've done what most people wouldn't have done. So we threw the whole economic model we threw out the window. Okay, we're not going to take a success fee of the deals. We're not going to charge investors. Even for founders, it's going to be 99% free. So we just accepted the fact that, okay, it's going to have to be a free service by far and large, but then we're going to monetize on a small slice of what we do and just leave a lot of money on the table. But if you don't do that, then you don't have a business at all. So that's what we've done. And now it's working out. But yeah, We needed a lot of time to get there and to figure this out. That's why we stayed as a side project for 2 years.
So when it comes to funding this project, was it bootstrapped or did you have to raise money?
So we mostly bootstrapped. We took a few angel checks from a few friends. We already burned for that money a long time ago, but it was like less than 200K USD. And really at this point, we're not going to raise more VC money. We're at a point where we grow at a VC pace that would make us VC-able, but we just don't need their money. And again, and by the way, this is what I profess to every founder who comes to OpenVC. If you don't see a clear path to $1 billion company, if you don't see a clear path to $100 million in annual recurring revenue, for example, don't raise VC money, because then they're going to have expectations. They're going to apply pressure on you, which is normal because that's what you're committed to, right? If I raise $2 million from whoever, then they expect me to grow super fast and IPO 10 years from now, 7 to 10 years from now. Today, I don't see that for OpenVC. I see other plays. I see really exciting, profitable, lucrative scenarios for us as a company, but I don't see the $1 billion exits 7 years from now. And so if I don't see that, I'm not going to sell that to investors. So that's my policy, my personal policy, and that's what I recommend to other founders as well.
Very interesting. So I'm glad you touched upon the finances end of things, because that was going to be my next question, that if I am somebody who's listening to this, I'm a founder, the first thing that I think about when I think about a VC is like, what percentage of the company is going to take, right? And now there's this OpenVC app, and now I'm wondering, how much money are they going to take from me? So can you lay it out for us, like how it works financially?
Sure. Okay. Yeah. So the short answer is going to be 15 to 20% for each round. And now if we want to go a little more into the thick of it, let's say that you have angel round, pre-seed round, series A, etc. The commonly admitted number is that the founders should collectively own 50% plus after series A. So once I've raised my A round, me and my co-founders, whoever we are, we should own 51, 52, 60, 70% plus. If you own less than that, it's usually considered that you're not incentivized enough. You don't have enough equity to go the long game. So it's a negative signal, actually. Okay. So that's the first number you want to have in mind, that kind of goalpost. And so starting from your first raise, you want to make sure you never give away too much. So if you're going to raise, let's say, one angel round, one seed, let's say one angel / pre-seed, one seed and one A round, you're going to give away, let's say, 15, 15, and 15. That's 45%. You're good. You still own 55 collectively. So it's a hard question, obviously, because every case is different. So I'm trying to give kind of guidelines that anybody can directionally look for. But yeah, if you say, okay, I have three rounds to my series A, and I don't want to give away more than 50% collectively. So that's how I look at it. And then on average, it's going to be 15 to 20% just because of the math, right? VC knows that they need, and we have content on that, but they're going to need 15 to 20 to equity stake in your company to return what they need to return by the time you exit. So it's a standard number in the industry. Angels are more flexible because it's their own money. They do what they want, but VCs are usually going to look for something in that range. If you're a very hot deal, everybody's fighting to get in, you can get the number lower to 10, 12%. But for most people, you're not hot, you're just normal. And so it's going to be 18%.
Then how does OpenVC, the company, take part on any of this? How does OpenVC get paid?
Okay, so we don't charge a success fee. So whatever you raise with OpenVC, we touch 0% of that. We don't charge investors, right? Investors can use OpenVC for free. This is going to change. We bring a freemium version for investors, but for now it's free. And for founders, they can sign up and use the product for free. We have a free forever plan that is very generous. And then we have advanced features. So if you want all the little whistles and bells, if you're a power user and you really got a lot of value from the free version and you want more of it because you see it's working, then the premium version comes at a month or $349 per year, and that's it. So that's the only way we make money. We have a little bit of ads as well, but that's it. So we're not going to take a lot of money from founders at this point. We're going for volumes rather than milking each user.
No, that's fantastic, especially for a founder to know this, that the cost of $99 a month or $349 a year companies, OpenVC, the company is only making money through the subscription program. They're not tapping into any of the funding that the founder is receiving, not tapping into anything. So it cannot be a better deal for a founder who's looking to get started, looking to get their feet wet, and potentially end up with a big deal with another VC. So that's wonderful.
Hopefully, yes. Actually, a few people that we know of who closed with OpenVC, closed investors found on OpenVC, they were all free users. So sometimes people ask me, hey, if I pay, do I have more chances to raise? And yeah, of course, you're gonna go faster. But at the end of the day, you raise because of you. You don't raise because of us. We're just a channel. We're a pipeline to investors. But at the end of the day, it's the quality of your startup that seals the deal.
I love it. I love it. So any words of wisdom to somebody who's getting started outside of the tactical phase? Because this is a journey that is mentally very tough, and hope is a drug. And as entrepreneurs, we are so in love with the baby that we have that sometimes, even when the signs are everywhere, we continue to pursue it because it's a drug. So how does one navigate this space mentally? What are some tips that you have, having built your own company and worked with others who have done the same?
Honestly, it's an amazing question, and it's one that I'm very careful to answer because this is all about out. So we can give general rules that will be true for 95% of people, but that one person will define the odds and go against the advice and actually be very successful. Like I said, like I often say, I'm just one data point. I'm going to share my personal opinion, but it's just one man's opinion. So if you're a first-time founder and the first time you're going to raise, my first piece of advice would be do your homework. Venture capital is a very specialized, specific industry. It's unlike probably anything you've done before, right? Most people have either been in the education world, being students, or they have been in the corporate world, being managers or employees. But being a founder raising funds from investors is a kind of relationship they're not used to, and interactions and way of thinking that is not natural for them. I'll give you an example. It's about investor feedback. So a lot of founders expect that, okay, I'm going to reach out to an investor and they're going to reply. And if they decline, they're going to give me a bit of feedback because that's how it's worked for you so far, right? Your teachers give you feedback, your managers give you feedback because that's the expectation. And also we're all being social animals and we're playing nice. But here you're talking to investors and it's a completely different dynamic. If they don't like you, they're just going to not answer, and that's the industry standard way to decline, right? Ghosting you. And then even if they reply and they're not going to give you feedback. And if they give you feedback, it's not even going to be honest. They're just going to tell you whatever so you don't feel too bad and move on because they have other things to do. So these kind of interactions for first-time founders, there's some adjustments, and some people get very emotional about it, and very frustrated and angry. I know a lot of bitter and probably some bitter founders. I hate VCs because I had one bad experience. I'm like, yes, that's how it works. So that's one. So do your homework, understand what you're getting into. Don't be naive. Maybe a second piece of advice. I had a founder 2 weeks ago. He's an OpenVC user and told me he got scammed out of $5,000 because he just believed in a fundraising advisor who's basically told him, pay me, I'm going to make intros for you. Nothing ever happened. They're not in the same country. He's never going to see the money. The guy stopped replying to messages. So there is no such thing as free lunch, and nobody can promise they will help you raise. Like nobody can guarantee you will raise funding. So don't be naive. If you're naive, it's on you, honestly. Like it's your mistake and you're going to learn from it, but be careful, especially when you're playing with your money, for a lot of people, they bet their family savings, they bet their house, their relationships, everything hangs in the balance. And so they're desperate, they're emotional, they're not thinking. So be careful. Don't put yourself in a position of total failure. That's why I applied to myself with, right? We took 2 years. We were excited about the project. We wanted to go all in from day one, but we're like, okay, if it doesn't work, if it works, but slower than we want to, then what happens? And eventually we're like, okay, it took 2 years, but we got to a point where, okay, we're making enough money that we can go full time and it's a safe bet for us. And we're in a position of strength. By the way, now we're in a position of strength. If we want to raise funds, even if we choose not to, but if we wanted to, we can. We have investors contact us from time to time, say, hey, are you guys raising? I have interest. And we say, oh, okay, cool, thank you. Not at the moment. But you want to be basically, ideally put yourself in a position where this saying, right, the battle is won before it started or something like that. It's the same thing here. You want to make sure that this is something you can win and don't go into a desperate position. And so many founders make that mistakes because, like you said, hope is a dangerous drug.
Love it, Stefan. You are so open and honest and straightforward with good practical advice that this podcast recording is literally just worth its weight in gold. So thank you so much for coming on the show, for sharing your insights, not only talking about this great platform that is really changing the way founders and investors can get connected. Any last words for our audience members?
Like you said, your startup is your baby and you need to nurture it and you need to take care of it and give it love and everything. Like a baby, when you look at the baby, you think my baby is the most beautiful in the world. But for other people, they think your baby is ugly and they're probably right. So always keep a bit of healthy distance with your own project. And remember that it's a marketplace when you're raising funds, right? You're actually selling shares of your company on the market and you're competing with other products, which are other companies also raising from the same investors, competing for the same bucket of money. So your baby's probably ugly. It's okay. Just don't be too delusional and best of luck because yes, it's an uphill battle. It's not easy.
Thank you so much for being on the show, for sharing such great insights, Stefan. Can't wait to have you on the show again.
Thank you, Mark.